It's the end of the year. Do you owe income taxes? Hi, this is financial planner Sean Mullaney. Let's discuss. So most, not all, but most Americans with W-2 jobs tend not to owe a whole lot of income taxes at the end of the year, although they might, right? Because there's W-2 withholding, right? It just happens when you get your paycheck every 2 weeks, every month, every week, whatever it is. So you get that W-2 withholding there, getting the money paid into the IRS, to the state if applicable. And so maybe you got to up your withholding for November, December, right? So that's okay, that's fine. But retirees can struggle with, hey, you know what? It turns out my income was a lot higher than I thought it was going to be, or I just wasn't attentive to this. And I'm looking at it and boy, I am under withheld, or maybe I haven't done any withholding for my income taxes this year. And am I going to face a big penalty? Well, I have a mechanism that can help you out if you find yourself in that situation. And it's an IRA withdrawal. Right? So think about this, right? You're retired, you got a traditional IRA. You can, in theory, go in there, all right, and say, hey, you know what? Vanguard, Fidelity, Schwab, E-Trade, whoever it is, right? Doesn't matter. I want a $10,000 distribution from the traditional IRA. I want a $5,000 distribution. I want a $20,000 distribution, whatever it is. And you say, they're going to ask you, how much of this do you want withheld? Well, if you need to get $5,000 paid into the IRS, elect a percentage that gets at least $5,000 going to the IRS from the withdrawal. And maybe it's 99% of the withdrawal goes to the IRS and the state government, and 1% comes home to you, and you go out to PF Chang's with it, right? The idea is withholding from a 1099-R, from a traditional IRA, works just like W-2 withholding. And they don't ask, well, was this done evenly throughout the year? It's all deemed to be done equally throughout the year, right? So that could be a great way to say, oh, crap, we just got behind. We didn't figure this out, and we got some income. There's a little bit of a drawback. That's going to be taxable, that distribution. But that's not that big of a drawback, right? Because it might be a very small amount. You're just trying to avoid the penalty. You have to look at last year's tax liability, this year's tax liability. You just get enough paid in through that 1099-R withholding. It's called 1099-R withholding. It's basically you took a taxable IRA withdrawal, but then you moved a bunch of that to the IRS and or to the state. So that's a great way to resolve under withheld situations in retirement. But now you're saying, well, wait a minute, I'm retired and I'm under 59 and a half. That doesn't work so well, does it, Sean? Because I'm subject to the 10% early withdrawal penalty. And that is true, at least initially. Now, there are exceptions, though. One exception is the so-called rule of 55, but that has to be from a 401k or other qualified plan. So that may or may not be available to you. You may not have any money left in your old 401ks. You may not be 55 when you separated from service, or older than that when you separated from service, based on your 55th birthday year. So that may not be so readily available. What could be readily available to an early retiree is a 72T payment plan. Oh, what's that? All that is you agree with the IRS to do a calculation, and I've done this on the YouTube channel and Google Sheets. You do a calculation where you say, well, for the longer of 5 years, or until from now to when I turn 59 and a half, I'm going to take a series of substantially equal periodic payments from my IRA. And you right size the IRA, you make it really small. Maybe you only owe $10,000 to the IRS. I say only. But it wouldn't take a big IRA to produce that with a 72T payment. You have this one-time hit where it's a $10,000 taxable event, but somebody's paying tax on that IRA at some point anyway. So you take $10,000 out before 59 and a half, no big deal. Gets you straight with the IRS for this year's taxes. And then you say, well, wait a minute, Sean, I got to take that $10,000 out every year. Well, maybe not, right? You could, in the next year, switch to the RMD method, which I've talked about. And now you're taking out a much lower payment, and that's just for the rest of the 72T term. You could use that for tax withholding, and it's not even that much anyway. So a 72T out of an IRA might have this sort of unconventional use, which would be to solve an underpayment problem in 1 year, and then you either just keep it going for the modest amount, or use it for withholding in future years for the modest amount, or you switch to the RMD method and you reduce it still. So if you're retired, look, you should be attentive early in the year to your estimated taxes, but if it got to the fourth quarter, you weren't so attentive. If you're under 59.5, you might want to just start a small 72T payment plan, send most of it to the IRS, and then figure out in later years, maybe just keep sending it to the IRS or switch to the RMD method and lower the amount. Hope you enjoyed this video. If you did, please mash that like button and subscribe to my channel. I'll see you next time.